Question: who here knows what a lifetime ISA is? A lot of people ask, can I get a mortgage? During the mortgage, people will often ask me, why is the bank asking so many questions? And how much does it cost to buy a home? Not just the deposit, but the other costs involved. We're going to go through that right now because these are great questions and these are also important questions. So first up, this is why a lot of people are listening right now. Can I get a mortgage? Yes, you can. It's very rare that I speak to someone and they cannot get a mortgage. There's a difference between being able to get a mortgage and potentially getting the amount that you want for the home that you want. But in most cases, people can get a mortgage. So don't listen to your cousin, don't listen to people from wherever you're from that have come here and gone through the process. Speak to a mortgage advisor. Speak to someone that's going to give you the factual information and answer your specific questions and tell you how much you qualify for. But let's go through some of the things. The first thing is, how much do you earn and how is your income made up? So are you self-employed? Are you full-time employed? Are you part-time employed? Do you get benefits? All of those things are important. So the lender is going to want to understand where you get your money. One of the things to be mindful of, I know a lot of hardworking people that have more than one job. Not every lender will accept a second income. Some lenders will only accept one income. Some lenders may accept a second income as long as you've been there for 6 months plus or 12 months plus. Some will accept a percentage of that income. So just be mindful. If you have a full-time job and a part-time job, that's great and that will help you. And, hats off to you for working hard. But when you're speaking to your mortgage broker, they may advise you that, yes, your first job you're making 30, your second job you're making 10. It doesn't mean that the lender will view that as £40,000 per year. Also, lenders are smart. So don't think you can go get a job for, a month and a half and then add that to the application and the lender's going to say, yeah, we're going to take that. Lenders know that some people will do that to boost their income. This also applies to commissions and bonuses. Some lenders will not accept a bonus unless it's a guaranteed bonus and they've seen you receive it for several years or a couple of years. So your income is very important. The other thing that's very, very, very important is, what is your visa status? So if you have a UK passport and you're applying for a mortgage in the UK, then it's pretty straightforward. But what if you have right to remain? What if you're on a skilled worker visa? Well, none of these things will rule you out, but it does change the criteria. I do a lot of mortgages for people that have skilled worker visas. And yes, I get them mortgages. One of the bits of pushback that I often get is, well, Anthony, you've given me this particular interest rate. All my friends are telling me that there's better rates out there. Keep in mind, every mortgage is different. Every situation is different. And the rates for people on skilled worker visas might be a little bit different than the mainstream rates for both people with a UK passport. Or what happens quite frequently, I have lenders who maybe have a lower rate, so your high street lenders, Halifax, Barclays, who will do the deal as long as the person has been in the UK for at least 3 years and has enough time left on their visa, but they won't lend as much. So you might find that the high street lender will lend you the money, and one of the other lenders that specialize on skilled worker visas will lend you the money. But the people that specialize on skilled worker visas will lend you more money. So that might be why I or another broker take you to the other person, because you needed more money to buy the house that you want. We spoke a little bit about credit. It's your credit history. So don't get just caught up in the credit score. Yes, the credit score is very important. And usually the credit score aligns with a good credit history. But think about things like, have you missed payments in the last 6 months? Have you had any late payments within the last 6 months? So quite frequently I have clients that have a high credit score, but maybe they've had a late payment in the last 3 months. That will impact which lenders will lend to you. Also things like CCJs. A CCJ is a county court judgment. Is it satisfied or unsatisfied? So if you're checking your credit report every 6 months, you should know if you have these things. You should know if it's satisfied or unsatisfied. If you do get a CCJ, what you want to do is make sure and satisfy it. There's lots of lenders, especially if it's with a utility bill. A lender kind of will exclude that if it's a satisfied CCJ and it's with a utility company. So don't just ignore it. Don't think that it will go away. Defaults, CCJs, even repossessions. There are lenders that will lend if you've had a property repossessed in over 6 years. There's some that you don't even have to wait the 6 years, but the LTV or loan to valuation will be a lot lower. So they're not going to do a mortgage at 5% and possibly not even a 10% deposit. A lot of them are going to need at least a 25% deposit to kind of get past the fact that you've had a repossession in the past. I've worked in banking for 30 years, and 10 years out of that 30 years, I actually worked in pre-litigation and debt collection. And I can assure you, banks do not want to foreclose. Banks want to lend money. Let me say it again. Banks want to lend money, but they have to lend responsibly, and they have to make sure that you can not only borrow the money, but you'll be able to keep up your mortgage repayments. So this brings me on to the next point. When people say to me, banks don't want to lend, that's a myth. It's a lie. It's not true. Of course, banks want to lend. Banks are in existence for the purpose of lending money, but banks need to lend responsibly. So banks need to know that the source of income is legitimate, the source of the deposit is legitimate, that you can maintain the payments, that you're not going to retire during the course of the mortgage, and if it is going beyond retirement, that you have a pension in place. One of the considerations that they're going to look at is it a joint application, meaning two people, or is it a solo application? I need to explain this to people. If you do a joint application, both individuals, if it's two people, on that mortgage are both individually and jointly responsible for the monthly payments. What do I mean? All right. So if you and your partner take out a mortgage and the payments are £1,000 a month, and you decide you're going to pay 500 and your partner's going to pay 500, the bank doesn't care. They just want their 1,000. So if one of you loses your job or one of you decides that you're not going to pay anymore, you cannot go to the bank and say, well, my partner's not paying his part. Let me just give you my part. A joint application means that both of you need to meet the criteria for that mortgage. So a good rule of thumb is that the criteria will be based on the worst person. So the person with the worst credit profile, or the person with the, that doesn't have the UK passport or whatever, they're going to take those things into consideration. And that's going to be one of the ways that they determine what the loan to valuation is. There's a common myth out there about percentages. Oh, 5% down, 10% down, 15% down. A 5% mortgage does exist. It's a little bit more challenging. There are even 100% mortgages out there right now. So there are lenders who will lend 100% of the mortgage. But these are all things that are for perfect clients, UK passport, PAYE, those type of things. So they do exist. But the best bet is to speak to a mortgage broker. A mortgage broker is going to deal with lots of different lenders. And as long as you're open and you're honest with your mortgage broker, they'll be able to give you the best advice. They'll be able to show you what they're giving you and explain why they're giving you that particular product. We talked about the credit profile, but I'll say it again. If you have CCJs, if you have defaults, if you have repossessions, don't rule yourself out. It is still possible to get a mortgage. You may need to go to a specialist lender, which means the rate may be a little bit higher, but you certainly can get a mortgage if you've had a CCJ, default, or repossession. If you've had late or missed payments, you can still get a mortgage. It may rule out some of the top tier lenders, but you still will be able to get a mortgage. And another consideration is what they call debt to income ratio. So I had a client a couple months ago who's on a decent salary. They pay their bills every month, never missed a payment, never any late payments. But just for the demonstration purposes, the individual was on a £50,000 a year salary, but their debt was about 65,000. It was above their income. Whilst they had a decent credit rating and they hadn't had any missed or late payments, the lender would not lend to them because the debt to income ratio was too high. That particular lender wouldn't lend to them. We did look at other lenders, but most lenders would, based on that debt to income calculation, most lenders were looking for at least a 15% deposit. So think about your credit profile. Every time you're applying for credit, anytime that you have a bill that comes through the mail that's due, make sure that you are on top of your credit profile. Make sure you're not missing payments. Make sure you're not making late payments. Make sure that you're checking your credit report so you don't get any nasty surprises if and when you apply for a mortgage. The other thing that banks are going to ask, and it's not because they're being nosy, is where did the deposit come from? Okay, is the deposit being gifted? In other words, do you have a rich uncle? Do you have a parent? Do you have a family member that is gifting you the money? That's fine. But do consider some lenders will only accept gifted deposits from direct family members. So that would be, a sister, a brother, a parent. Some lenders will take it from anyone that will lend you the money. But when someone is gifting that deposit to you, they're going to have to prove where that money came from. Banks want to make sure that they can determine the source of the deposit. So if someone is gifting you a deposit, tell your broker early that they can go to a lender that does accept gifted deposits, and they can look at the criteria, because you will find that some lenders accept gifted deposits, but they don't accept the full deposit as a gifted deposit. They want to know that the individual has some skin in the game. They want to know that the person who is borrowing the money has saved some money towards the purchase. So gifted deposits are fine, but make sure you let your broker know about the gifted deposit early. Make sure that the person that is gifting the deposit is willing to provide their bank statements, and they will need to sign a gift letter. So it's a gift and not a loan. I am going to touch on something which is point 3. Listen, my parents are Jamaican, and a lot of Jamaican people that came over during Windrush used to do something called a partner. So a partner is one of those cultural things that with the Jamaican community, what would happen is, let's just say you have 5 people that are in this partner each week or each month. Let's just say each month to make it easy. Each month, everybody would put in £1,000, and each month someone gets that £5,000. I know that in some communities it's called rounds. These things are a great way to save, but banks do not like that. Let me say it again. Banks do not like to see multiple payments coming in from multiple sources into your bank account. Furthermore, and this is a discussion that I've had with several people, keep in mind, it's not a gift. Some people, when I'm doing their mortgage application, they're like, oh, it's a gift or it's my money. It's a loan. It is a loan, which means you have to pay it back. So if you're in the partner or if you're in rounds, that £5,000 that you're getting is your money anyway. because you're in it for, let's just say, what we call hands in partners. You're in it for 5 hands. So you've put in 5,000. But the great thing about it is it has given you access to that money sooner than you would have otherwise had it. But banks do not like rounds. It's hard to explain. It's hard to get over that hump. It's not impossible, but if you can avoid it, do avoid it, because that same 5 months that you're putting in that 1,000 a month, you could have just put that in a high interest savings account. And A, the bank would see that you're saving that money each month. And B, you'd actually get interest on it. So you'd actually be better off putting that in a savings account than, circling it around and potentially ruining your opportunity to get a mortgage. Crypto is another thing. You can use crypto towards your deposit, but you'd want to let your broker know that in advance, simply because some lenders don't accept crypto. And if they do, there's a much higher threshold of due diligence that they're going to take you through. And proof of the origin of the money, as I said, you want to make sure that you can prove the source of the money. So in most cases, at the very first stage, banks are going to ask for 3 months bank statements. If they think something isn't right, they may ask for 12 months bank statements. So don't think that you can trick the bank by saying, I'm going to do the rounds, and then I'm going to get the money in the account, and then I'm going to get the 3 months bank statements, because I know 4 months out is when the money came in. You may run into problems because you may end up being asked for 12 months, and then you're going to have to explain why you said that the money was yours, but in fact, it was something that came from rounds. There's something called open banking. So banks, with your permission, can see what you're doing with other banks. We do go through your bank statement. So we will look and say, well, who is Jane Doe and Jack Smith and Frank? Why are these people putting money in your account? So when you're building your deposit, the best advice I can give you when you're trying to build a deposit for a home is open a high interest savings account, which in 9 times out of 10 will not be with the high street. So it won't be Halifax, it won't be TSB, it will probably be an online bank. I mentioned earlier that you can go to Money Savings Expert. These are reputable organizations. These are banks that are protected. You have the same protections as the high street banks. It's just because they can give you more interest. So open a high interest savings account each month, or whenever you're paid, put some money in that account. The bank will see that, the lender will see that that money has been built up. And then it's easy to use that money for your deposit. So that's how you will show where your deposit came from. Additional costs. Oh my goodness. Additional costs. This is one of my favorite topics, and sometimes it's a little bit scary for people, and sometimes it can be one of those things that they have the conversation with the mortgage broker, and now they're disheartened because you're talking them through the additional costs that maybe they did not consider. One of the first things that I tell people is the deposit. So the money that you're paying down on the house, although at the beginning of the process, you do need to provide proof of deposit, that money for the deposit towards the purchase will not come out of your bank account until about 2-3 weeks before you get your keys. The average mortgage is taking 4 to 6 months right now. And 50% of mortgages don't happen. So either the seller pulls out, the buyer pulls out, various things happen. So your deposit is really, really important. But that's just one thing that you need money for. You're going to need money for stamp duty unless you're below the threshold. But there is a government website that you can go on, key in the information, and check to see what your stamp duty is going to be. You're going to need to pay a solicitor. So the solicitor fees are going to be determined by the price of the property, if the property is freehold or leasehold. Leasehold properties are going to cost a little bit more. You're going to need to pay your solicitor. You're going to need to pay your broker. If you go directly to a bank, banks don't traditionally charge broker fees, but When you go to the bank, you're only speaking to that bank. So, particularly if you have a skilled worker visa, you may find that the bank says no. So, they're not saying that you're a bad client. They're just saying that within their criteria, maybe they don't lend to skilled worker visas, or maybe you haven't been in the country long enough, or maybe you don't have enough time left on your visa. But you're going to need to pay a broker if you're going to a broker. There's product fees. So a product fee would be the particular mortgage that you're taking out may have a product fee. Sometimes they don't, but they usually are about £1,000. So that's what the bank is going to charge you to take out that particular mortgage. I always advise that clients add the product fee to the mortgage. And the reason why you should add the product fee to the mortgage is because product fees are non refundable. Remember earlier I said that 50% of mortgages don't go through? So that means if at the onset you pay that product fee when you start doing the full mortgage application and you change your mind or the other person pulls out, you won't get a refund on that. So I always advise add the product fee to the mortgage. The downside is you pay interest on it. But the way to get around that is when the mortgage completes, you contact the lender and say, look, I want to pay an additional £1,000 or £1,500, whatever that product fee was. But keep in mind, the additional costs are money that you need to have. If you're paying your deposit out of a lifetime ISA or some type of ISA, like a help to buy ISA or whatever, keep in mind, they're not going to give you that money. The bank doesn't give you that money. That money will go directly through the solicitors for the purchase of the home. So the additional cost that you need to keep in mind when you're purchasing a home is the stamp duty, solicitor, broker, product fees, valuation, and moving. So valuation is where the bank that is lending you the money is going to value the property. They're going to say, we think it is worth X. And there can be three outcomes from that valuation. Valuations will range depending on the price of the property. Some mortgage products will come with a free valuation. But when that valuation is done, there's essentially three outcomes. Outcome number one, they value the property at the amount that you agreed to purchase the property for. So you found a property, you've negotiated, the seller's selling it for $500,000, you start the mortgage application, you key in that it's $500,000, the lender goes out, sometimes they do what's called a drive-by valuation, or they could even do what's called a desktop valuation, where they just can key it in because there's a lot of houses that have been sold in that area, and they'll say, yes, we think it's worth $500,000. The other outcome could be that they think it's worth more than $500,000. Great result. But if they come back and say that they feel that the value of the property is lower than the $500,000, that's where you have a problem. So you'll need to speak to your mortgage advisor and adjust the mortgage amount. And that's why it's important not to purchase right up against your maximum borrowing ability, because if something like that happens, it may mean that the deal completely falls out of bed. So those are some of the additional costs to consider when you're getting a mortgage. Action. Speak to a broker. Don't wait until you think you're ready to speak to a broker. I offer a free mortgage capacity analysis report. So if you contact me, the link will be in the description. I will actually do a full mortgage review for you and tell you and show you how much you can get. Even if you're not ready to buy now, you should speak to a mortgage broker at least 6 months before you're ready, because there may be some things that you can tidy up. I had a client about a week ago now, and he actually did a really good review for me where I could have gotten him a mortgage right now. But based on some circumstances he had, I said, listen, if you wait until January, you will have way more lenders that will be able to lend to you. So yeah, if you absolutely need to purchase now, if you're going to be homeless, or yes, I can get you a mortgage now. But I think it would be better for you and your family, if you can, for you to wait until January. You're going to have more options. You're going to have more choices, which means with more options and more choices, we'll be able to find you a cheaper mortgage. He wrote a great review saying, you know what? I didn't think a mortgage broker would do something like that because I told him, look, I could take your business now, but it's better for you and your family to wait until January, which is about 6 months from now. Clean up your credit. So if you have small balances on credit cards, make sure that you pay them off. Make sure that you don't have lots of things out there and stop applying for credit. Do not apply for any more credit while you are looking for a home. Even once you've started the mortgage application, don't apply for any more credit. All right. Get in your new home and you might find that you need things. And a lot of people don't realize that when you get your new mortgage, 9 times out of 10, your credit score will drop. And it drops for two reasons, because you've just taken out this huge loan, and also because you will change address. Unless you're purchasing from a landlord for where you're currently living, you're going to change address. So that is going to impact your credit score. Tidy up your bank account. Banks will go through your bank statement with a fine-tooth comb. So you want to make sure there's not random things on there, silly things. I had a young man that I did a mortgage for where he had loaned someone money, and when they were paying him back into his account, they put a really horrible reference on there, and the bank will question those things. So tidy up your bank account. If you have any direct debits that you no longer need, cancel them. We want to get you the maximum affordability, that you can get the maximum mortgage amount that you can afford. And review your mortgage and equity. So like, let's just say you already have a home and you may have some equity. Look at it. See what things you could do potentially to invest, or to do home improvements, or to help, a child onto the property ladder. There's lots of older people that have homes that they've lived in for a while. They have equity, and then they have young people that are struggling to come up with a deposit. Your home is going to be their home when you pass. Let's just face it. So why not use some of the equity in that home right now to help them get on the property ladder? These are some great action points. I hope that you follow them.